Hi, this is Anthony, parent of IRSMedic, and are you searching the internet to try to figure out where you want to retire? Some of the most popular destinations to retire as Americans are Canada, Mexico, the United Kingdom, France, and Australia. We're going to talk about the various differences between the vast differences between retiring with one or the other in relation to their tax treaties. And also, we're going to show where a tax treaty might not make all the sense, but here's what you need to know. There's a huge difference in what your tax requirements with the IRS are and filing requirements are, depending on which country you retire in. And also, America is one of the top destinations for French residents, UK, Canadians, and Mexicans, and Australians to retire to. So we're going to cover the other way as well. Joining me today is John Richardson. He runs expatriationlaw.com, and he's at expatriationlaw.com on Twitter. He runs citizenshipsolutions.ca. He's joining me today along with Keith Redmond, who helps a global advocate for the American overseas. Good morning, gentlemen. How are you doing? John, I have a question for you. Does it really matter what country I retire? Let me take Keith's position and be that devil's advocate immediately. Does it really matter? Does it really matter where an American retires?
Well, of course it matters. They continue to be subject to U.S. taxation, and believe me, their overall tax picture is going to differ dramatically from one country to another.
All right, let's go to a great country to retire to, France. Why don't we just talk about that, and then, because I think that might be a nice place to go, and then we can kind of explain the other ones, how they work out so well. So is France a good place for an American to retire to?
Well, Anthony, France is an amazing place for an American to retire to. Interestingly, I mean, if you want to put that post on the screen, up to you. A couple of weeks ago, I wrote a post specifically about a very unique provision of the U.S.-France tax treaty that basically allows U.S. citizens who are resident in France, to receive U.S. source retirement and investment income, basically without being subject to French taxation on that income. So, that's an amazing thing. I think you want the other post, Bonch.
Yeah, the other one right here, right? Yep. So in this article, I'll link to this article here so people can read that more in depth. But
yeah, you want the other one, Anthony. Bonjour.
Bonjour. Oh, here we go. There we go. This is what we
want.
want.
Yeah.
Okay, so this is what we want. We'll be talking.
It's the only word I know in French, by the way. But it's a relatively short post. But for anybody who is considering the possibility of retiring in France, I think it's well worth the read because, there's a historical context to this. But, Article 24, which is the general avoidance of double taxation provision in tax treaties, is quite amazing in this treaty. And in addition to the usual, France extends a special benefit to American citizens residing in France, namely that it will not impose tax on certain U.S. source investment U.S. income. And as I think I've said before, I wonder why this would be. And, I remember that, years and years ago, France gifted the United States the Statue of Liberty. I don't know that France has given the United States a lot since. So perhaps this provision, Article 24 of the French-U.S. tax treaty, is France's gift to American retirees.
Well, it's so nice.
It's an extraordinary thing. I mean,
Well,
this is
nice.
why it's not, France isn't the best place to get support for ending citizenship taxation, by the way.
Oh, okay, because we have a lot of people who believe the current regime is helpful to them, and any change
is beneficial to them.
No,
Yeah,
that's not
right.
necessarily. So
how true is that? Is my question. Is that if the U.S. changes to residency-based taxation,
it doesn't change anything. It doesn't change anything. And so for someone to support the status quo because they're afraid of losing their special French tax treaty benefits, you're mistaken. There won't be any change whatsoever. Really, what would happen is people in other countries around the world won't get the hammer so bad. Now, one thing I do want to point out, while France is a great place to retire to, if some of you remember a guest we've had on a couple times, Kathleen Demeron, she's been on and she's been having a hard time living in France. And the difference is that she's trying to work and run a business in France. And with all the various tax rules and the Foreign Account Tax Compliance Act, it's proved impossible for her, and she's abandoned attempts to try to make money in France. So again, it's different. If you are a retiree and you will add no particular, you're not trying to create anything in France, you're just going to go there and live, then everything's okay. But if you're trying to, and you have one spouse who's not retired, then look out. Now I want to go to the other side of the globe.
Before we go there, Anthony, one point that I think is very interesting about this. I mean, there's a tendency when people look at these issues to compartmentalize and look at the issue only. But if we look at this contextually, and we talk about Kathleen, so the U.S. is very, 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 very clear that by God, it's going to impose U.S. taxation on French source income earned by a resident of France. By God, yes, that's the American way. But on the other hand, as part of the treaty, France is going to refrain from imposing taxation on certain U.S. source income when the individual lives in France. Isn't that incredible?
Isn't that incredible? Well, I guess, what, this would be a good time to ask if it does it work the other way. What about a French retiree moving to the United States? Does the United States government refrain from taxing French pensions as they come in?
Well, now that would be Article 18 of the treaty. And in that case, yes, here's the rule in Article 18. Article 18 applies to a situation where you have pension income sourced in one country, but paid to a resident of the other country. And the rule is that the income is taxed only in the country of source. So if we have, for example, a French person receiving a French pension who is a tax resident of the United States, then only France would tax that income, right? And of course, the other way around. If you have a U.S. source pension received by a resident of France, then that would be taxed only by the United States, right? Okay, and I would point out that the Article 18 provision is dependent on residency, okay, tax residency, not citizenship per se, with one small exception, and that is that under Article 18, France does have the right to, I guess France has the right, I think, to tax the U.S. Social Security payment of somebody living in France.
All right. So,
let's see what it says here. Payments under the Social Security or similar legislation to a resident of a contracting state or to a citizen of the United States. Let's see, whether paid periodically, blah, 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 shall be taxable only in the first mentioned state. Yeah. So what it says specifically here is that U.S. Social Security, so I was mistaken a minute ago, U.S. Social Security payments paid to a U.S. citizen are taxable only by the United States, right?
Yes.
Okay.
All right.
So
yeah,
I have
ahead,
a
Keith.
question, if I may. So if I understand correctly, John and Anthony, is that France is the only country that has this special relationship with the United States, whereas the other countries, it's not as attractive for an American retiree to go to UK, Germany, Mexico. Is it only France?
That's my understanding.
Only France has the special Article 4 type provision, okay, which is the avoidance of double taxation. All right, there is no tax treaty that I'm aware of that is as generous as the U.S.-France tax treaty is. I mean, it's really, really extraordinary.
Okay.
However,
historical
and I
context to it, but it's definitely extraordinary.
It is extraordinary. However, one of the confusing things is that you don't necessarily want to look to the tax treaty for the answer as well. First of all, tax treaties don't mean what they say, and the second problem is you have a savings clause which can undo everything, and you have your carve outs, and so it's incredibly confusing.
Yeah, it might
And
be
I think,
worth adding, okay, well, before we leave France, that if you look, if you get down to the bottom, Article 29 of the Treaty Savings Clause,
yep,
notice that the benefits of both Article 24 and Article 18 are not affected by that. Okay, are not.
Okay.
right. And so, that's a really good point, because a lot of you'll read a tax treaty, get all excited,
Yeah.
and that savings clause comes out and takes away everything good, and that's sort of the nastiness of it. There's this thing called a savings clause. It's saving the government, not you. Okay, that's the way to think about it.
Right.
Well, and now I'm thinking, another really, really popular place to retire is Mexico. Now, the tax treaty doesn't have these kind of benefits, but there's something else that goes on in Mexico that makes it a pretty nice place to retire. Now, John, you were mentioning that to me. What is that? What makes Mexico that we won't find it in the treaty, but it's true, and it makes it an okay place to retire?
Yeah, well, what you do is you always start out. I mean, these treaties apply to people who are tax residents of various countries, right?
Mm-hmm.
So the starting point is actually to look at the definition of tax resident. Tax resident means that you're subject to the full force of the tax code by a country, right? Okay, and if we look at this, it's interesting because this is an OECD summary of what it means to be a tax resident of Mexico, right?
Mm-hmm.
As a general rule, all individuals who establish their permanent home are deemed to be tax residents. Okay. Notice that this, contains sort of a breaker provision right in the beginning. Okay. But you'll notice also it says that for these individuals who temporarily use real estate for touristic purposes shall not be considered as having established their permanent home. So basically, if you retire in Mexico in a way that's not your permanent home, you're not going to become a tax resident of Mexico. And what is interesting about it is that I don't see anything in here that specifically focuses on number of days, right, or anything like
Yeah. Yeah. That's what I found most interesting. It's split up by your revenue, not where you are, but this right here. When more than 50% of total revenue obtained by the individual within a calendar year arises from sources within the country, or when the main center of their professional activities is located in Mexico. So read that the other way around, right? Okay, if 50% of your revenue comes from, if most of your revenue comes from the United States or elsewhere, and when Mexico is not the center of your professional activities because you're retired, it seems like you don't need much outside. You don't need to be outside the Mexico all that much. A few visits would probably do it, because you can't say, a few visits to California or wherever would probably do it. Sounds like.
Well, what it means, I think, in very, very simple terms, is if you're a U.S. citizen and Mexico is not your permanent home and your center of financial gravity remains the United States, which is retirees abroad, I think you're presumptively going to avoid tax residency in Mexico, which is a good thing. Okay. Because once you establish it, it's not that easy to break.
All right. Well,
if you look further down in the treaty, but I think that's why there's two reasons why Mexico is a very popular retirement destination for Americans, right? First is,
it's there.
Interestingly, that Canada, actually does not allow Americans to retire in Canada. Canada does not have a retirement visa per se for anybody. And
that was going to be my next question. How is Canada? That's so
interesting.
To sum up, Mexico is a great place, but not as a function of a tax treaty, but rather just Mexican law about.
That's right. Yeah,
they're just making a unilateral, like, we're just not going to consider you a tax resident. And I'm figuring they're doing that for, hey, look, we want we want U.S. investment, and this is a way to get U.S. investment a little easier in here. That makes sense. And so that just, without a treaty, Mexico is great. So let's talk about something you may have a little familiar with, the Canada. So is the United States a good place for Canadians to retire to, and vice versa?
Well, the answer's really no on both counts.
Okay.
First of all, Canada does not have, what's commonly referred to as a retirement visa. Okay, Mexico does. If you want to, retire to Mexico, you can do that. Canada does not. It doesn't mean that you can't move to Canada after retirement, but you have to do it in a different way. You have to be setting up a business, or they have what's called a family super visa if you have relatives and certain relatives in Canada. But the reason for this, I think, is that Canada has a national health care system, and they don't want just anybody to be able to move there and start using the health care system.
Ah.
So, even people who move there under this family super visa thing have to get separate health care. However, that does not stop somebody from becoming a tax resident of Canada. All right, because remember, the rules for tax and immigration are somewhat different. Now, for most retirees, I don't think being a tax resident of Canada is per se a problem. However, if you start opening up a bunch of Canadian bank accounts, et cetera, then you're going to have problems on the U.S. side. In any case, bottom line, Canada is not an attractive place for U.S. citizens to retire. Mexico is. And this, by the way, is another example of the conflict over the citizenship taxation problem, right? Because, the people in Canada are tax residents of Canada, are working in Canada, trying to build their lives in Canada. The Americans in Mexico, by and large, are the opposite, right? I mean, their center of financial gravity remains the United States, et cetera. And, Mexico, by the way, is a very easy place to get permanent residence of. But I'm not sure I would become a Mexican citizen because, interestingly, if you look at the tax rules for Mexico, I don't know if it's on the screen there or not. Maybe scroll down a little bit. But there is a provision. I guess it's not there. Go up. Now we're talking entities. Move back up. There is a provision in the Mexican tax law, interestingly, that says that Mexican citizens are presumptive tax residents of Mexico. Now, it's not that difficult to rebut the presumption, but I would say it's opening the door on citizenship taxation, with that. I mean, it's not actually doing it, but it's, a statement that Mexican citizens are presumed to be tax residents of Mexico, right? I mean, it's easy to rebut the presumption, you don't live there, but it's interesting that that's a provision there.
Interesting. I have, if I may, and forgive me, but I'd like to travel to France for just a second. With the France-U.S. tax treaty, does that include France as well as its overseas territories that you can retire to? Is there any stipulation there that it's only mainland France? Or could you retire to French Polynesia or New Caledonia, et cetera?
Don't know the answer.
I don't know the answer, and it came up.
Just look at the treaty. I mean, in Article 1, it's going to tell you exactly what they mean.
Okay.
By
by France. Okay.
Yeah. By the way, one other point on the France thing. Okay. I mean, obviously, it's a fantastic deal. I mean, however, I've had people who renounce U.S. citizenship in France, even though they're going to pay more tax, interestingly. Okay. Although it's a fantastic deal, I would point out that what the treaty says is that in effect, they're not going to tax that U.S. income, or that U.S. citizens resident in France will not pay French tax on that income. But that income is includable for other purposes in France. Okay, like determining, I think, what tax bracket you're in, and some kind of various other things, healthcare and this sort of stuff. So it's a great deal, no question. Okay, but there are implications that go beyond income tax.
And I think I can answer the next question myself. I'll try a stab, and you correct me where I'm wrong, John. It's not. The U.S. is not a great place for Canadians to retire to. I mean, a lot of Canadians in Florida. It's not a great place for tax purposes, though, because your Canadian pensions are fully taxed by Canada, and they'll be taxed again as a U.S. person. However, if there is a foreign tax credit that you paid to Canada, you'll get credit for that. The foreign tax exclusion doesn't apply because you are no longer living, you're not overseas anymore. So am I missing something on that? Is that, and then basically, then too, you have to deal with the whole FATCA nonsense on all of your Canadian.
So you're talking about a Canadian,
who retires in
US
Naples, Florida. There we go. Yep.
Right.
Yep.
Yeah. Well, there's going to be issues on a number of fronts. Okay. I mean, first of all, the pension income in that is still going to be sourced to Canada.
Yep.
Of course, you pay the tax in Canada. It would use as a tax credit in the U.S. But there are two other bigger problems. Okay. The first is that a Canadian who wants to move to the United States and sever tax residency from Canada is going to generally be subject to Canada's departure tax.
Oh.
All right. Yeah. Which is similar conceptually to the U.S. exit tax, but not quite as brutal because it has exclusions. So most Canadians, if they're well advised, might want a vacation or winter in the United States, but they would not want to sever tax residency with Canada, okay? Because that's going to subject them to the departure tax, right? I mean, and, this can be, a lot of money, right? They'd have to pay.
And hang on, I just got to grab a charger here. My laptop's about to die. Hang on one second.
Yeah, so Anthony, the departure tax is a very real issue for people, okay? But a second issue is that, so if a Canadian wants to move to the United States, they probably would want to take the position they're dual tax residents, all right, and just how they can use various credits, to minimize taxation, etc. But I would also point out that if they become U.S. tax residents, they're going to be subject to all the reporting requirements, including, 5471, 3520. Now, a lot of Canadians who might retire are going to be the shareholders of what are called Canadian-controlled private corporations, which under the U.S. Treasury regs, by the way, are deemed corporations, all right? And that means that they're going to be subject to really, really draconian reporting requirements, right, on their Canadian corporations. And, very possibly taxation under the, the GILTI, the Subpart F regime, etc. So this is a very, very serious problem. It's going to subject them to foreign asset reporting in the form of Form 8938, FBAR, all kinds of things. And, I've had this conversation with a lot of people, obviously, over the years. And I think that if they want to move to the United States, they need to be very well advised. They need to be very, very careful. There are some unique provisions in the Canada-U.S. tax treaty that, for example, if they sever tax residency with Canada, they're subject to the departure tax, and there's a provision in the U.S.-Canada tax treaty that allows for recognition of that in the United States at the same time, right, to, sort of align the timing on the taxes and stuff. But, and then they've got the problem of healthcare, right? All right, because they're generally going to lose their healthcare under, for example, I'm in Ontario, so it's called OHIP, if they don't maintain certain presence in Ontario. So,
Well, it sounds like
I would say it's not a good idea.
It sounds like if you're if you're thinking of Florida, I would think of Mexico instead, because the same rules apply to Canadians as Americans. Well, we're not going to make you a tax resident.
I think that's right. I think that's probably right, because I think they're probably going to be able to avoid becoming a tax resident of Mexico more easily. However, if a Canadian had some kind of a property in Florida or Arizona, if they don't spend more than 120 days a year there, they're not going to become tax residents of the United States.
Okay.
And of course, that I mean, the stupidest thing they could do is get a green card. All right, clearly. All right.
Yeah.
But if they're conscious about maintaining minimal ties, with the United States, then I think it's probably okay. All right. But they really got to be careful because there's a whole set of problems that come from two really independently brutal tax regimes, meaning the United States and Canada, from trying to tax you simultaneously.
So I want to move to
And one other point on this, Anthony, before we go. Just getting this out here, I do not think that Canadians should be buying properties in Florida or somewhere, okay? Because sooner or later people die. It's going to be a big probate problem, et cetera, et cetera. I mean, if they're going to do this stuff, just rent. Just go there for 4 months, rent, enjoy yourself, and in that way steer clear of all of these problems.
Oh, okay. Yeah,
because it would create a major headache for their heirs in Canada vis-a-vis probate. Is that what you're saying?
Yeah,
John?
well, you got to hire a Florida lawyer or Arizona lawyer, to manage that aspect of it. I personally, well, me, I hate lawyers, I hate accountants, and I hate bureaucracy. I really do. Okay.
Well, you came to the right place then, huh?
And I think that the best way for people to die is with nothing but debts. Personally, okay. But if you die with stuff, you got the problem of probate means getting everything distributed according to the will, and if that means transferring the title to a property in Florida or Arizona, how do you do that? You have to call up some lawyer in Florida or Arizona to do it.
Yeah.
And by the way, if you think you're going to get that for $99.95 or something, chance. They know they've got you over a barrel,
right?
And you're going to be paying a lot of money. I just don't think that owning these vacation properties, which is how they're seen.
Sell yours, yeah. So sell yours in Florida. It's a great time. It looks like from the cap rates, I've been told a great time to sell, and maybe find elsewhere. So my problem is this: I live in Connecticut year round, and I've been thinking about snowbirding in Florida myself, just like many other people. However, the truth is, I really, really hate winter. I mean, I really hate it because even in Florida, the sun isn't as strong in the winter. And so I'm thinking for myself, you know what? I really need to snowbird. A place that would be more appropriate for me to go in winter is where it's actually summer, Australia.
Yeah.
What about that? Tell me about that. Is that a good place for Americans to retire to? Australia, for those of us who have a difficulty with this crushing winter despair that is remarkably getting better, because today is a day that's not January. And so I celebrate that. Where it's Valentine's Day today, guys. Wow. Happy Valentine's Day. So I really need to get out. I need to make a big change in my life and, live at least half the year, become more than half the year in Australia. John, would that be a good idea?
I think it might be a good idea if you can actually physically do that, in the sense of, will Australia let you do that? I don't know enough about Australian immigration rules, but Australia has, I think, a national healthcare system like Canada, and I don't think they're not going to let. I do know they don't let people easily just immigrate to Australia to live. I mean, you're going to find this for any country that has, national health care and, a lavish system of social benefits, right? They don't just, let people walk in. I don't know enough about it. My guess is that it's probably going to be difficult.
And I think we know the answer the other way around. How about an Australian retiring to the United States?
Well, I think it depends largely on whether they're going to sever tax residency with Australia, right? I mean, Australia has departure taxes,
right,
et cetera. And I think it depends what you mean by retire, okay? If by retire you mean just spend time in the United States because you like it without picking up tax residency, and you're sure you have health care benefits, I mean, I think that's fine, Okay. But if you're trying to pick up the whole apparatus of becoming a U.S. tax resident, I think that's not fine, because you're coming from a system where your financial center of gravity is Australia, right? Okay, so all of a sudden you're arriving in the United States. Welcome to the United States. We see that the center of your financial life is foreign, and we're going to punish, form, and tax you appropriately. So be prepared for the penalties in your future.
Yeah.
I'm not sure why somebody in Australia would do that.
They have, because I've no, and,
Yeah.
and that's the thing. People do it because they'll get the immigration first before the tax advice first. So it's certainly, and that's sort of what happens. And so we don't mean to rub it in at all. What I encounter with the retirees is in the U.S., the Australian retirees, is that their superannuation funds, that is their retirement funds. For those who aren't familiar, it's a mandated retirement fund. The IRS is intentionally vague on what's actually required for compliance, leaving the door open for what we think is the best way to report these, but there's various degrees about what is what, and the IRS really isn't taking action to give that clarity. It's sort of the terrorism of being vague. It's really wonderful.
Yeah. So Anthony, what you're describing, I think, is how are they characterized, right? Are they foreign trusts or not? And if so, what kind of reporting requirements would apply? The 3520 and this sort of stuff. Leaving that aside for a moment, I mean, isn't the real problem that the income's not taxable in Australia but is in the U.S.?
There you go. Right there. Thank you for that. Right.
Yeah.
Right. The most obvious thing. There's a compliance burden that stinks. And don't get me wrong about it. And that's usually the thing I'm focused on because that's what we're doing. I'm not the one paying the bill. So
but
you're absolutely
bear
right.
in mind, though, remember that they've got to be a U.S. tax resident for that to kick in, right? So I think that the discussion really is, an important component, part of the discussion is, how does an Australian enjoy life in the United States without acquiring U.S. tax residence? Right. I mean, that's the way you've got to look at it.
I have a suggestion. Mexico.
Well,
I think I might be doing a public service announcement for Mexico, because it seems like, well, if you're looking for a place to retire that's warm and during our summer, Mexico won't necessarily create that tax residency for you either. And being close to the U.S., if it is something you do have family in the United States, well, it's a lot closer than Australia, so that might be a better option for you.
Well, yeah, I mean, notice that the common thread that's running through this whole discussion, okay, is always tax residency.
Yeah.
Okay.
Yeah.
So, and that's different from the immigration status. Tax residency is different. So, mostly when people talk about spending time somewhere else or moving somewhere else, right, they immediately sort of default into, well, what does it mean from an immigration point of view? Do I need a visa? Can I do this? Can I do that? Right. And that's a very, very different question from the whole tax residency issue, right? So, using an example that I know best is probably the most common. So a Canadian, doesn't need a visa and just show up at the U.S. border with a passport. And I think the answer is they can actually stay for 6 months, as a visitor, right? I mean, not, taking employment, but just, I want to drive around Florida, right? I don't think they should stay for 6 months because they're at least opening the discussion on tax residency issues. They may be able to avoid it through a closer connection test or through a tax treaty tiebreak and avoid it. But, it's work, and they got to have a conversation with a lawyer, which is always bad news, right?
Oh, yeah.
Et cetera. So people approach this, they never approach it from the point of view of what does this mean, if I stay too long, or what does it mean? Are there certain visas that in and of themselves mean you're a tax resident? And this is why you don't want a green card, right? I mean, the worst thing, I'm convinced, the worst thing that somebody can do who wants to go to the United States is go there with a green card. Unless you're sure you're going to live there forever, and you want to get citizenship, for a variety of reasons. Because, I mean, one reason is that if you've got the green card, you're a U.S. tax resident, whether you're in the country or not, right? That's it. If you're a tax resident based on a substantial presence test, well, at least that's tied, to some presence in the United States. So I would be very careful of any kind of visa anywhere in the world where that visa is a sufficient condition for tax residency. Now, obviously, I don't know what's going on everywhere in the world, but I will say that the United States is the only example I'm aware of, right, where a certain kind of immigration visa, makes you a tax resident until you get rid of it, right?
And it has nothing to do, right? It has nothing to do with your days in the United States.
That's exactly right.
It's an odd thing. Someone's a permanent resident who isn't in the United States.
Well, I mean, I have worked with untold number of people over the years who got the green cards, and they think that because you have to renew a green card every 10 years under the immigration rules. By the way, if the failure to renew it doesn't mean you lose the permanent resident status, it just means the card is expired. They think that letting the card expire terminates tax residency, and it doesn't. And and one of the things that I have sort of evolved into spending a lot of time doing is helping that kind of person, who's left the United States years ago, solve this problem. And it's a very, very big problem. And again, I think the best advice I can give anybody who's not already caught in it is don't get the green card.
Unless you,
if you avoid it.
And it is, if I may interject, it is a fundamental problem. And I know that just dealing with expats when I'm in the U.S., that they focus on that green card, but they don't focus on the tax implications. And I guess would you say that's the fault of the immigration attorneys that don't bring up that subject?
I think fault is a very strong. Because law is so complex.
Yeah, I wouldn't.
Very few general practice out anymore. But
I don't know if I'd want to. I don't know. Yeah, I wouldn't want to dump that on an immigration attorney. Well, you should have known all of this.
But shouldn't an immigration attorney? I'm sorry, I'll just make this statement and we can move on. But shouldn't an immigration attorney at least say you should take a look at the tax implications and leave it at that?
Probably.
Well, I think they do.
Oh,
right. It's just that they're so horrific. Nobody believes.
Right? How do people?
They are.
No one wants to. No one wants to.
And the other point I would make is that that if you want to go to the United States, there's tax planning you need to do before going there. Like, for example, I'll just give one example. Okay, if you are coming from a country that doesn't tax capital gains on a principal residence, for example, right? You want to sell it before you become a U.S. tax resident, because as Anthony himself has pointed out, over the years, if you arrive in the United States, you rent the thing for a few years, you sell it, you're going to be taxed on the whole gain from the point of having acquired it. So, I mean, these are small things that people can and should do. And that's one of, many examples. I mean, sometimes people avoid this problem by setting up pre-immigration trusts. But the bottom line is this, okay, what people need to understand is there's a reason it's called a green card. Remember Kryptonite from the Superman comic books? Yeah. It's green. Green card equals kryptonite, everybody. Okay?
Well, it makes money for the United States. So that's where I thought you were going with it. So, and what John's saying is true, that when you move to the United States, your basis in the property you move here with isn't what it was the date you became a U.S. person. It's the date of your acquisition. So if you inherited a property that was worth not a lot of money, 1945, something like that, as a child, you inherited a large property, didn't really have it, or a bunch of gold. And you're like, yeah, just it's family wealth. I'm going to become a U.S. person. And then you go to sell it. Okay. It's like, well, now, and you sell it that year as a U.S. person. Your gain is not the gain from that, the months of you being a U.S. person. It's the decades preceding it. And that's why, if you actually think about it, you can have tax rates that exceed, any percentage amount because you're not taxed on the income.
You can end up
You're
paying
not,
more in tax than the acquisition cost of the property easily.
Right.
Absolutely.
But another
Right. So
point on this that is very, very interesting, and since we're so deep into this, I do want to make this point. I would not say, I don't know that the United States is unique in this rule, but I will say this, that Canada has a different rule, that when people become tax residents of Canada, the basis in the property is the value on the day they become a tax resident. Okay, so let's say that you're sitting there and you have a choice of, and you have assets, right? Let's say that you're sitting there and you have assets, and you have a choice of moving to Canada or the United States, right? If you're just looking at tax hell and the potential for problems, choose Canada. Okay, I mean, it's not even close. Okay, it's not even close. I mean, both countries are going to tax your pensions, on an ongoing basis, et cetera, whether they were taxable where you're coming from or not, subject to anything in a treaty, of course, right? But the treatment of foreign assets from the perspective of each in Canada and the United States is very, very different. Okay, very different, with the U.S. being far more punitive. And, for people who are concerned with maintaining generational wealth, for example, Canada's by far the better country to move to, even with higher income tax rates, right?
The United States does some crazy things, that's for sure. That makes any other country in the world look sane. It's just a fact that no American can complain about another country's crazy taxation, because ours is by far the craziest. Now, I want to move to we have time for one more, and this is a big popular one. I know a lot of I have no friends who've moved here, and we have a lot of citizens. We have a lot of retirees we represent as well. The UK. The UK, I tell people, it's actually got an okay treaty for some things because it gets us out of some hard reporting requirements.
For which way, Anthony? For Americans going there or Britain?
So John, what would you say about Americans going to live in the UK? Is the UK a good place, okay place to retire?
Well, it depends how long you think you're going to live. I mean, it certainly can be, because the UK has what's called a non-dom tax regime. Okay. Now, what the non-dom tax regime means, and this is a bit of an oversimplification, but I'll get the point across, is that if you become a tax resident you move to the UK, you become a tax resident of the UK for a certain number of years, you're able to exclude foreign source investment income from taxation. So this is, this is the whole brouhaha with Prime Minister Rishi Sunak's wife, right, last year. So, I mean, before you get overly excited, let me just add one other component to it. But the point is that what the UK is actually doing is preserving a certain form of territorial taxation, right? In other words, that they won't tax income received outside the territory, okay, earned outside the territory, unless you bring it into the UK, right? You have to keep it offshore, so to speak, right? But that's okay, for a lot of people. For a certain number of years, what you do is you pay a fee, you pay a flat rate to the UK government in return for the privilege of being able to exclude certain foreign source income from the UK tax base. Now, in some cases, this can be a pretty awesome deal. I understand that Prime Minister Sunak's wife is a major shareholder in an Indian company called Unisys. I think or something or other, Infosys, or anyway, some major Indian technology company, which they have been using. I was about to say the word shield. I think I'll use the word shield, but I don't mean in a pejorative sense. I mean simply, the UK will not tax that, right? As long as it's not brought into the UK. So this can be for wealthy Americans. Yeah, I think that the UK thing can be an interesting opportunity because I believe it's like up to 15 years before worldwide taxation kicks in, meaning that they're subject
Okay.
to tax on all sources. Also, in this context, UK does not have an exit tax. Mexico, by the way, does not have an exit tax, right? And so these are things that I think ought to be considered as well. Meaning simply that if you sever tax residency with Mexico or the UK, you're not going to be subject to the draconian measures of the U.S. exit tax or Canada's departure tax, etc. So yeah, I mean, I think the answer is that it can be very, very helpful.
And I would say you got to get some professional advice in the UK.
Oh, in spades. Okay.
Yeah, right. Exactly. You
In
need to talk to that. And hopefully, and if there is if there is anyone in the UK who wants to be a guest on this, please reach out to me, aparent at IRSMedic.com. Love to have you on. What about UK citizens retiring in the United States and becoming, as we say, a tax resident, as that is our focus?
Right. I would look, I don't know the answer off the top of my head, but I will say this, that the US-UK tax treaty is a pretty sophisticated treaty when it comes to taxation of pensions and things like that, far more so than most other countries. And I would look there as a starting point. I mean, if you're going to move from one country to another, right? I mean, I think the first question you ask is, how am I going to live when I'm there? What are my income sources? Okay. Now, obviously, if you're moving there to take a job, well, there's your answer, and that makes it pretty simple. But if you're moving somewhere and you're planning on living off income sources from outside the country, right? The first question is obviously, how are they taxed? And you answer that, question by starting with the domestic tax code, which probably says if it's Canada or the U.S. that it's going to be taxed because, income from all sources. But then you look to the treaty. And again, these vary so much from country to country that I don't even attempt to keep them in my head. But if you were to look to Article 18 of the U.S.-UK tax treaty, I think you'll begin to find some answers, okay, to that question. And of course, you want to pay attention to, I mean, who is it that's moving to the U.S.? Is it a U.S. citizen? Okay, remember, because, that will affect the application of the tax treaty. Or is it a UK only citizen, right, who's coming to the U.S. on some kind of a visa, right? Perhaps a green card, immediate family, or something like that. And then the second question that you have to ask is, what am I leaving behind in the sense of assets? Corporations, trusts, real estate, anything at all. And you want to ask yourself, not only how is that taxed, but what reporting requirements might exist with respect to that stuff. So, I mean, you want to ask that as well. And I really am inclined to think that if people rationally look at and consider all of these rules, I think that a lot of them are going to decide it's not worth the risk and the trouble to do that. And I would point out that is true even though most people, I think the consensus is that U.S. income tax rates, if we just look at income tax rates, are probably lower than tax rates in other countries, largely because the highest U.S. tax tend to not kick in, right, until, higher levels of income, et cetera. All right. But don't forget they've got state income taxes. Okay. And the property taxes in the U.S. are simply unbelievable compared to equivalents in other countries. You live in Connecticut, I live in Toronto. I bet okay, I bet you pay 5 times in property tax for your house.
Yeah, it's
Than
pretty
I
odd.
do.
Yeah, and we apparently have low taxes in my town too. We're proud
Yeah,
of our low
yeah.
taxes, and they're insane because
I mean, I
to
don't even
pay,
have to ask you what they are because I know,
yeah,
I know
it's
enough
not,
people who, I just know
yeah,
that,
and
the whole system of taxation is very, very different, right? So,
yeah, and
this is a question that people need to ask as well, and I don't think anybody should make that kind of move without, going on a some kind of a fact-finding mission and pretending you live there for a year and say, what exactly would I be hit with, for various user fees or taxes or whatever. I mean, I find and this is why, a lot and immigrants to the United States, right? They'll look at the salary levels in many cases and say, oh my God, this is incredible stuff. I can start as a lawyer in New York City for, multiples of hundred thousands of dollars a year, this sort of stuff. But, you kind of have to say, I mean, if you can have the high salary and have that salary paid to where you live outside the United States, I suspect that it would be a lot of money. But if you're getting that high salary and you're trying to live inside the United States,
you pay for it.
it's pretty clear, that it gets eaten up awfully quickly, right?
Yeah.
Yeah.
So I think, I mean, there's a lot of factors here, obviously, and more due diligence is required for sure before people just,
Well, and I'm thinking of some of my own clients too who are retired and living in the United States, and what it comes down to is if is it a good deal or not. It comes down to like, well, what's your income like? If it's all coming from retirement schemes, which I learned that scheme is not necessarily
It's not pejorative.
it's not pejorative, right? Isn't that crazy? I went, what? They call it scheme and they mean it.
Yeah.
What's a scheme? Tell me about your financial scheme. Just cracks me up. So if it comes in from there, it might not be that bad. But as you're implying here, if you have foreign controlled corporations that you own and are your assets, that's really where you're going to want to talk to someone. Maybe there's a way to structure that ownership differently so that your U.S. tax obligation isn't that bad. But it's really, we always say there's no, we say there's no, one answer for everybody, and truly mean that here for retirees, because the difference in the type of your income could determine whether or not it's a good deal, bad deal, or if you need to do some restructuring in order to make moving to where you want to move worth it from a tax perspective. And look, we can all handle some bad news and bad taxes, but you want to know ahead of time to say, okay, look, you want to move to your dream location, fine, that's great. Here's the bad news. This is what it's cost. And then if you know that ahead of time, to say, okay, well, look, there's a true tax on me living here. It's called this terrible tax. On top of it, if you know that, well, then you're making an informed decision, and then whatever it is whatever it is, and you're not surprised. What the part that I think we all, John, Keith, and I, are sort of always sort of hurts us on a personal level is the awful surprises people find themselves into when, it would have been nice if someone told them, hey, look out for this, do this one simple trick before you become a U.S. person, and you could save your fortune. And really, there are those simple tricks that some people need to do. So I think it really does start off with talking to a professional. John helps a lot of people around the world with green cards try to figure out what they're going to do, usually leaving the U.S. tax system. And my firm often helps people join the U.S. tax system. Welcome to America. And Keith is hearing all of everybody around the world, how it's actually impacting people and keeps us in charge of all the changes that are going on. So we've covered a lot of countries today, but there might be a country that you would say, I wish you would cover this. I want to know if it's a good idea for me to retire that. Just leave the country you would love us to cover in the comments below. And I'd love to hear back some feedback from people in these countries. Just let us know how it's going for you. And then if you are an immigrant into the U.S., retired here, please let us know how it's going, some trends you've seen. This is a conversation, a place where we're building a community of all of us around the world, helping those people trying to live around the world and being one of those people trying to live around the world. See, we're all about a time here, so I'm just going to sign off for Keith Redmond and John Richardson. This is Anthony Parent for IRSMedic, and got to thank you for watching. Again, leave those comments below. We'll respond to every one of them. Thanks for watching.